Hey guys, this is Coach Kelvin here with another segment of DTC group coaching. Today we're going to be dealing with some aspects of your emotions. We're going to be speaking into how to trade when you act, how to trade and act in your own best interest. Okay, let's see if we can make this thing happen today. Let me know, guys. You guys see my screen okay? Just go down. I got the chat box. It's open so you can chat me and I will see your responses and we're going to go from there. Okay, today, let's start going. First thing I want to say to you guys, good, I can see it. Emotions-free trading is so essential to your success in trading because let's face it, our mind does play tricks on us. It plays tricks on us, especially in the area when we're dealing with our money. When your money is on the line, you do all kinds of willy-nilly things to protect your gains and to make sure that your bottom line is met. And it's the same as you secure your bank account with your passwords. You secure your email with your passwords because you protect things that are valuable to you. But I find that when we operate in the area of trading or operate in the area of things dealing with money, our emotions get very much tied into the things that we do to secure our self-being, to secure our self-being, or to secure what we think or what we would perceive as being valuable to ourselves. So I want to talk into how we deal with trading and be emotion-free. But the key to all of that, the key to everything I'm speaking about there will be dealing with when you're day trading, you have to act in your own best interest. You have to act in your own best interest. I know you say, well, Coach, what does that mean? Well, that means that you have to take your gains as the market gives it to you, not expect market to do anything for you outside of what it's going to do naturally, because you getting a trade does not change not one thing when it comes to your trading. When you get in a trade, does not change not one thing when it comes to your trading. Let me tell you, we're going to call this here let's say we're going to call this the tale of two traders. Little story here. Okay. Before I get there, we'll go how you will consistently act in your own best interest when trading. That's what we're going to talk into today. That's my topic. First of all, keep emotions out of your trading. First of all, keep emotions out of your trading. It's strictly technical. You have a point of interest, you have an area of support, you have an area of resistance, and you're somewhere in between. And you're looking to say, where is the market going to go? It's going to go up or down. You're going to make a logical decision to give a probability 50-50 of where the market is going to travel to. And once you get that framework in mind, you have the opportunity at that point to decide whether you're going to go long or short. You've already did the research. You've already planned out the trade, so you have your risk parameters in place. At that point in time, you should be totally detached from the outcome of the trade. You should be totally detached from the outcome of the trade. What does that really mean? That means that when I push the button and I get in that trade, I am 50-50. Meaning that I'm going to be 50% chance it's going to go higher, 50% chance it's going to go lower. I really don't know. So therefore, I'm not going to be attached to the outcome. What I'm really attached to is the execution. When I'm going to actually push that button, when I push that button, am I pushing the button in the momentum phase of the trade that's going in the direction that I choose to go? Or when I push that button, do I just do it because I don't want to miss nothing? The candle start moving real fast and I just say, boom, I push the button because it look like it's going to go. Them are some of the worst times that you can enter a trade because we know our big thing here at the coaching is TLP, time level price. What's the time? I know when the time is going to be. What's the level? The level of interest is where you're looking to get into your trade. And where's the price in reference to that? If they all three line up, if they all three come into agreement with one another, you take the trade. So it's like this here. Time, what's the time? Where's the level? Is the price in the level? Yeah, take the trade. If it's not in the level, walk away. We know another thing. So since we know that If the time is right, we only trade at certain time periods, 30-minute cycles. If the level is right, we know that we can go in confidence to take that trade with our plan trades matched out. So therefore, we should not be sitting back emotionally tied to the outcome. It's 50-50. Your job, your only job when trading, is to be a risk manager. If anybody asks you what you do, you say, I'm a risk manager. What do you do? I manage my portfolio. What do you do? I protect profit. Other than that, you have no variance on what the market's going to do. So let's talk about that. And that's where I want to spend some time at today, dealing with the emotional free trading. Acting in your own best interest. I think this is pivotal to everything that we're going to do. Acting in your own best interest. The most important concept that you can ever embrace when you come to trading is to be successful is to act in your own best interest. Meaning that when the market gives you gain, what do? You capture that gain and you hold on to it, and you do not give the money back to the market. What would that do for you? That will give you a level of consistency, because once you make a gain, you lock it in and you don't give it back. Now, this is all derived around you setting realistic goals on your day trading strategy. Meaning that I have a goal that's realistic that I'm going to get in the market today. And we talked the numbers last week about if you made $100 a day or $200 a day, where you would be at in the area of annual percentages of gain. So when you get into the market with your trade, whether it be your first trade or your third trade, because we limit the amount of trades that we do, once the market has released unto us a certain degree of money, we got to be smart enough to capture the portion of the money that we can. And if that money meets our goal, we stop trading. If that money comes close to our goal, we stop trading. If that money gives us a third of the way to our goals, we can continue trading. But in the event that you are $50 away from your goal, don't start trading again. Because remember, we said that if you want to make $500 a day and you come to $450, close enough, stop trading. Now, why would you stop trading if that's your first trade and it's very early in the morning? Because we really understand that the market is just like Vegas. You stay there long enough, they're going to get their money back. And the market will do the same thing for you. Because this is what happens to you guys. Okay? Not just you, me, everyone. Once we lock in that profit, it starts to shift our mental ability to think clearly when we were into that trade. Now, hear me out. Don't shout me down. Just hear me out. Because when you go back in the second time to get that extra $50, what do? Most of us do this. We take and we'll, instead of our short being, our stop being what it necessarily has to be, behind the wick, the lowest wick to your left, that's where it should be placed at, we'll take and put our stop half of that way through, or a third of that way through, and we in the wrecking zone of the pullbacks, and guess what happened? Comes back, hit our stop, and we lose an extra $50 because we're trying to save, not put the 5-point stop, we want a 1-point stop in. Then we lose another $50. Then we lose another $50. Now what you're doing is revenge trading, trying to get the $50 back, and you end up giving the whole $450 back to yourself. So this is what I would charge you with today. Acting in your own best interest is to make sure when the market gives you what it's going to give you, then receive that with great joy and run for the hills. If you can master this skill, you're going to be very successful in this business. That means that you're going to trade less and make more. What does that mean, Kelvin? That means that every day you're not going to hit the $500 goal that you have set for yourself. When we say average, hear this out, average $500 a day. That means some days you're going to make $100, some days you're going to lose $500, other days you're going to make $300. But over the average of time, you'll go back and do your number. You say, I'm averaging $500 a day. That means that on some days you may make $800 or $1,000 a day. And then other days you may make half of that. Other days you'll just be flat. You may decide not to trade because the market is not presenting favorable conditions. acting in your own best interest. If you do not master this here, you're destined to fail, meaning that you're going to be blowing up your accounts. I know for a fact I blew up 5 accounts. And you do not want to be that person, because you are what we call a disciplined trader. You are what we call a disciplined trader. So that means that I am going to do all I can to master my emotions, all I can to make sure that I, myself, have all information I need so that I can continue capturing the right profits at the certain target areas. What does that really mean to you? That means that when you notice areas of support or resistance that's in the front of your trade, that is coming to where you got your profit targets at, you have to wise up, pay attention, move your stop into play, or set an area where you're going to scale out of the trade if the price pulls back to a certain area, because every area of support or resistance are areas where price can turn around. So acting your own best interest means lock in profit, period. Lock in profit. It is very, very, very important that you live in the area of locking in profit and taking profit. One thing we have to understand, that trading is a business. Trading is a business. What does that mean? That your business in this arena is to take gains out of the market. Your business is to make extra dollars for your retirement account, for your vacation account, for whatever that is, so that you can continually grow your account till one day you become a full-time trader if you're not a full-time trader. Let me give you a story. I wanted to share this here of 2 traders. One of them name is Dave. Okay, Dave was a day trader, and he was a brand new trader. And now this is me, my story. Okay, and he comes into the market, and right off the bat, without much knowledge at all, but just learned the basic concepts of getting into the trade with the candlestick stars, support, resistance, the basic homework that we all need to do before we actually put our money on the line. So for about 6 months of trading, doing pretty good, getting in the trade and getting out, making profits, and everything is going well. Know the parameters of making a trade. Now, the only thing is that after a certain period of time, became more aggressive. When I say became more aggressive, I'm a high D. Everything I put my hands to turned to gold. Okay, I'm using myself as a story. So with that cockiness and so forth, I began to do this thing we call over trading, meaning that I'm trying to take every dollar the market perceives to present that I can take off the floor to take out of the trade, and I'm trying to capture all moves. So instead of taking 1 trade or 2 trades or 3 trades a day, I'm taking 15, 20, 30 trades a day. What happened to me in a period of 6 months, I noticed that I was losing more trades than I was winning. My P&L went from green to red. Now I'm in a panic mode. I'm not gaining money now. I'm losing my own reserves. And what I noticed now that I look back over time is that my whole concept of trading and being profitable changed as I increased the frequency of the number of trades that I took. So my consistency went way down. My losses were small. Then it became bigger and bigger and bigger. And days I would have days where I have $2,000 red days, $3,000 red days, $4,000 red days. And I couldn't figure out what was going on. What happened was this, and you guys may be able to identify with it. FOMO, revenge trading, that was the big one. Meaning that I had to make that money back. So now my strategy was put my stop behind the lowest wick to the left. But my strategy changed because I was in desperation mode. I was drowning, and I started moving my stops to areas that it should not have been hit more often. And out of the 20 or 30 trades, 15 of them were red trades. So I took the 15 losses that I created, the 15 losses added up to big losses, but they all were small, and it was like death by 1,000 cuts. So what happened there? What was the reason that my trading started changing? Was for the bare fact that I lost control of my emotions. I started acting out of area of desperation rather than good common sense. What's good common sense? I have a strategy, but I'm not following it. What is good common sense? Okay, having a strategy and following it. So when I lost perspective of what I was, because I was looking at the market to try to get back what I lost, and what I should have been doing is living and trading in the moment. Living and trading in the moment. So I had to dial back, and I call myself a scalper, guys, and I'm pretty decent at scalping. Guys, mute your mic. Mute your mic, everyone. All right, hold on. Okay. Hold on. Okay. And therefore I had to reframe the things that I was doing. I had to go back to the drawing board. And when I really found this out is when I started journaling. And I'm gonna say this out. When I really found out what was going on is when I started journaling. If you are not journaling, you are not acting in your best interest. And guess what? Eventually, you're gonna blow up your account. Eventually, you're gonna blow up your account. So what I want you guys to do is to act in your own best interests. What I had to do was go back to the drawing board. And what I did at that point, I had to say I have to level back on the number of trades I'm taking. I had to be okay with the losses that I already incurred. So when I approach the market each day or each trade, I approach the market with a fresh perspective, with a right now perspective, meaning I'm looking at what is going on right now. I got the blindness off of my eyes because what I had was trader blindness. All I could see was the money I needed to get back. All I could see is that I didn't want to lose no more. I was hurting, but I didn't know how to stop the bleeding. Until I started talking to some traders that was around me that had more confidence, more success than I had, and they asked me the question, are you journaling? The answer was no. Okay. Are you over trading? And I said, what's over trading? I didn't know they had to limit the trades you should take. And they suggested that I dial back on the number of trades I was taking and only take trades that lined up with my edge. I'm like, what's the edge? I had to learn these concepts, relearn some things I knew, and I had to look for the support resistance areas and only take the trades that lines up with my edge, and therefore I would stop the bleeding. That's what they said. But the old habits were so very hard to break. So to be confident as a trader, you have to do something that you've never done before. That means that you're going to have to resist to take the trade when it doesn't line up with your strategy. Meaning you got to be okay with trading. You have to be okay with trading below 5 trades a day. Mute your mics, everyone. Okay. Hold on one second, guys. And be okay with missing some opportunities to come in play. So when I partnered up with the person that was helping me trade, they were monitoring what I was doing, and they was giving me pointers on where the areas that I was actually messing up. One of the things I was doing, I was trying to take every run that came out, and that wasn't okay. Okay, I was taking trades and not properly setting my stops, and had to change that out. So one of the things I want to say to protect your portfolio is acting in your own best interest, and I wasn't acting in my own best interest. I was acting suicidal. And I say that jokingly, but it's the truth. I was acting in an area where it wasn't my best interest because I would be up on most of the days, but I would end up red on most of the days because I was trying to get the money back. And that's where the problem came in at. So if you learn to act in your own best interest, you're going to make a lot of money when it's trading. If you don't learn to act in your own best interest, you will lose a lot of money when trading. I want to say to you guys that this does not have to be the case. As with the tale of two traders, let me go back to that. My skill set was good. My learning of the market and the learning of the values of the trades going back and forward and the variable movement was good. But I would always end up trying to hit the mark that I set for myself that wasn't really realistic. So in your own best interest, set your daily trading goals, make them realistic. Some people will say, I want to make $10,000 a day. Well, make $10,000 a day, it's going to be very hard to do trading two contracts, first of all, unless you get two contracts with a big run. And if you're using two contracts, guess what happens? You got to trade up a lot of times, probably 10, 20 trades a day. But if you're trading 20 contracts, I'm talking futures here, then you possibly can hit your goal each day. But the risk is so much greater, and most of us don't have the tolerance for big risk factors. So this is what I would say to you. Look at your portfolio size. Look at your risk to exposure comfortability level. Some of you guys are not comfortable with losing thousands of dollars at one time. Because if you're trading 20 contracts, a 1 point move with 20 contracts will put you down $2,000. Probably more, let me see, 10 contracts, 1 point will be $1,000 there. $2,000. A 2 point move, $3,000 or $4,000 to say. So that's not comfortable for most traders. So your goal for $10,000 a day won't be realistic. But in your own best interest, you're going to look at your portfolio size and say, well, my ability for a drawdown, I'm comfortable if I lose $500. Not that you plan to lose $500 or $200 or $100, but wherever that place is at where you can take that trade and be emotional free. Meaning that you're not sitting there sweating with your hand on the button ready to get out if it give you one tick in the wrong direction. That's where you lose your money at. But if you set the strategy up that works with your plan of entry and your proper stop, when it pulls back against you, it doesn't bother you because you've already measured twice and you cut in once. You measured out the trade, you set a realistic stop expectation, a realistic profit target, and a realistic entry. Therefore, you can sit back and be emotional, I'm trying to get a word out here, without being emotionally tied to the trade. Meaning that if you get stopped out, you're okay with the loss. And then if it comes back to your point of entry, then you go back and do it one more time. Because I would probe a trade 2 or 3 different times to get in with a smaller portion of contracts. So in your own best interest, this is another tip for you. Go forward and enter your trade with 1 or 2 contracts. Confirm that the run is going to be running, and if it does run, we know that trades go in a zigzag march. They go up, they come down, they go up. We call it downs or retest. So I'll use a higher time frame to enter my trade, and I use a lower time frame to notice the pullbacks. And when the pullbacks come in play on a confirmed move up or down, that's where I add the other 2, 3, 4, 5 contracts. And I found out that kept me more balanced in my trade, and I wasn't so emotionally charged with the trade. Learn to act in your own best interest. So I want to go here with this here. Doesn't take your skill set. You can be a great trader, but have the biggest losses if you don't have the right discipline in mind. You can be an okay trader. You can be even a not so good trader. You can be a brand new trader if you have sound risk management principles in place. Meaning that you're only going to take trades that lines up with your risk profile. That's the best way to put it. That's easy. Your risk profile, and you're going to avoid all other trades, even though you may be missing some trades that really run. But if it doesn't line up with your trading plan, then you're going to pull back and not take the trade and be okay with it. Do not let greed drive your trading. Do not let greed drive your trading. I want you to say, I'm going to trade less and win more. I have a concept that I was just talking to one of my students with the other day. We talked about trading 4 times a day. But you only can take one trade in the opening, if that's what you want to do, 1 trade at the other 3 opportune times to trade. And we know that is on the East Coast, 10 o'clock, 11 o'clock, 12 o'clock hour. We talk about the top of the hour and the bottom of the hour. We talk about how the bottom of the hour seems to present bigger moves than the top of the hour, but they all within the same framework. So if you just limit yourself to one trade in the morning, one trade in the 3 trades in the afternoon if the move presents itself. Now, the reason you're going to do this is that you're going to take the one trade, you're going to set your stop properly. That means they're going to give the trade room to run, and this is going to be your only trade for the opening. So therefore, you have to be very selective to only take the trade that line up with your trading plan, or you will not trade. Disciplined trader. For the second half of the day, you're going to do the exact same thing, but you're going to do the same thing, but you're going to be steadfast and sticking to your trading strategy, meaning that we know in our trade, we run with a 7-point stop. Whew, that's a lot of money. Let's face the fact. 2 contracts, 7 points, that's $1,400 on the futures. If you're trading MES, that'll be $70. That's a pretty big pill to swallow for a lot of people. So if that be the case, then you only can really afford to take one trade, whether it go right or wrong for yourself. But the smart person acting in their own best interest is going to take only the trade that really lines up with their trading strategy. What does that mean? That trade is going to line up in such a way that when it goes into the position to take the trade, you're going to actually be more confident because you know this works for you 50% of the time. You're going to only take that trade if it presents itself going in the direction that you're going to look at the trade in, whether it be long or short, in the area of multi-time frame continuity, meaning that you look at the higher time frames and you're following them for your entry, for your decision to go in the trade, whether it be long or short. If the trade that you're looking to take is opposing the higher time frame directions, you as an acting trader, one that's acting in your own best interest, you're going to avoid that trade at all cost. Okay? Same thing for the second half of the day, whether you're on the East Coast or West Coast. West Coast is 10 o'clock, West Coast is 1 o'clock, 11 o'clock, 2 o'clock, 12 o'clock, 3 o'clock. You're only going to look for trades at the top, bottom of the hour. You only can trade during the 30-minute cycle to look for interest. Probing is not a failed trade, meaning that I'm a probe to get in the trade, and if as soon as I get in the trade, it starts to go against me, I will cut the trade myself. I will wait for it to meant that I was too early. That's all it meant. I will wait for it to pull back into the opposite direction and come back to my area of interest, and I will hit the trade again, not risking my 7 points at that point because I used the higher time frames to trade with, but I'm using the momentum of the trade to pull me in, and once it gets locked in, the trade is confirmed and running, then the 7-point stop goes into effect. You got that. So acting in your own best interest, what you're going to do, 1, you're going to take profit out the market. 2, if you're not going to overtrade. 3, you're going to select the trade only at the top or bottom of the hour. 4, you're going to look to trade a minimum amount of contract to enter your trade. Once it's confirmed on the pullback, you're going to do your add-ins with your contracts, especially on a running trade. You can start with 1 and end up with 5 at the end of the trade. Yesterday was a perfect example. We had a great run on ES, and everyone that took that trade and used the proper strategy, you never got stopped out. You had a great day yesterday. So at this point, I want to just end this here call. Not the call, but in this portion of the presentation, and we're going to open it up for questions and answers. Remember, you don't have to make it all in one day. How do you eat elephant? One bite at a time. How do you eat elephant? One bite at a time. Remember, guys, this is a business. This is lifelong for you, and all you have to do is take and pace yourself through it, and just take your portion out the market. And if what you're doing is not working, go back to the drawing board and revise your strategy. Revise your strategy. This portion of the group call is going to end right